You can absolutely buy a home in Nova Scotia with less than 20% down. But there is one big secret that you need to have in place if you're going to do this. With me to explain what this secret is, as always, is Alex Lavender, a certified mortgage broker right here in Halifax. And so, Alex, can you please explain, if someone's going to buy a home with less than 20% down, what is that secret thing that they have to have with their mortgage?
Yeah, the big thing you have to have is you have to have mortgage default insurance. So it is something you have to pay for. It is something you need to get approved for as well. Um, yeah, it's kind of a tricky spot because if you have less than 20% down, you have to have it, and it doesn't do a whole lot to protect you. And it's not one of these insurances that's like a life insurance or a disability insurance that protects you directly. It actually protects the lender. So if you're to default on your mortgage, the lender, in theory, wouldn't be at a loss because this insurance would make them whole again.
So this is basically an additional fee that you have to pay in order to put down less money. That doesn't do anything for helping you in case you get like sick or lose your job, but it just protects the lender. So can you
Yeah.
explain to me then, at what percentage of down payment do you need in order for this to become mandatory, essentially?
Well, yeah, I mean, once you get to the 20%, you don't need to have the insurance anymore. The insurance premium itself, the cost of the insurance, depends on the tier that you're essentially in. So it goes in 5, 10, 15% increments. Those are all different tiers. Then there are premiums added on. If you are doing a 30-year amortization, there's like a 0.2% premium. There's also potentially a premium if you're doing a special stated income program as well. And there's also another premium if you're doing like a borrowed down payment program. So like, for instance, if you were putting 5% down, that premium, that insurance is 4% of the mortgage amount. So essentially kind of wipes out your down payment. Now, if you
Yeah.
were doing down payment assistance program or borrowing that money from a line of credit, not gifted funds, but actually borrowing the money, that would be about a 4.5% premium. And if you added on the 30-year amortization, now you're at a 4.7% premium. So you're essentially mortgaging the whole value of the house. Um,
Wow.
when you get to 10% down, that's 3.1%. And when you get to 15% down, that's 2.8% for the base premium.
And so for these premiums, which is what you have to pay to get this insurance,
Mhm.
how do you pay it? Like, is this a fee that you pay right off the bat? Is this rolled into your mortgage somehow? And then, so how do you pay it? And who do you pay this to? Like, do you have to go find someone to provide you this insurance, or does someone like yourself, a mortgage broker, line it up for you? How does that work?
Yeah, so you don't need it in addition to your down payment. It's just going to get rolled into the mortgage itself. So yeah, you don't need to find anyone to pay. Lender's just going to roll it into the mortgage, and that's going to be your new starting mortgage amount, for instance. So, if you had a $100,000 mortgage, to use an easy number, you're putting 5% down, $5,000 down. That means you have a mortgage of 95,000. If you add back in 4%, let's just say that's $4,000. It's not quite. That means your mortgage is 99,000. So essentially, you have a $100,000 purchase price. You put 5% down. You add back in the insurance, but your starting mortgage is 99,000, not 95,000.
Okay. So that sounds like it might increase your monthly payments for your mortgage. Is that right?
Mm-hmm. Yep, it would increase your monthly payments because you are borrowing more. And that does get rolled in one time. So you are paying that over the life of the mortgage too.
Okay. Does it affect the interest rate that you pay on your mortgage?
Mm-hmm. Yeah. So if you have mortgage default insurance, you're actually going to get a lower interest rate than someone putting 20% down, which
Hmm.
kind of seems counterintuitive in some senses. But when you put 20% down, there's no insurance. So there's some risk for the lender. When you put less than 20% down, you're paying this insurance. There's no real risk to the lender. It's very limited. And then they're going to offer the lowest interest rates available. And sometimes, that could be 1/4%, maybe even 0.5% lower than someone putting 20% down. Yeah.
And so a lower interest rate, that means your payments monthly would be lower as well, right?
hmm
So does that mean that your monthly payments are going to be comparable to what you would be paying if you put down 20%?
It's tough because you're not comparing apples to apples because 20% down is going to give you a lower mortgage, right? So like same example, $100,000, you've got the mortgage of 99,000. If you put 20% down, you're going to have a mortgage of 80,000. So you're definitely going to have lower payments on the 80,000, even if the interest rate's a little bit higher, but just because that sheer mortgage balance is going to be quite a bit lower. So um, hard to compare it because it's not apples to apples really.
Okay. And so if you're sitting there and you're in Nova Scotia or you're moving to Nova Scotia and you realize you're like, I want to buy a home and I don't have 20% down, but you now know that you have to get this mortgage insurance. How do you get it, Alex? Like, do you have to go and find these companies to do it, or can you go through a mortgage broker like yourself? Do you set it up? How does that actually work?
Yeah, it's actually set up on the lender's end per se, but there are three default insurers that it could go through, and sometimes it'll only work with one, or it might work with all three. They all charge the same premium, everything, so there's not a whole lot of difference there. So what would happen is when we submit a file to a lender for approval, they will go out to get the default insurance first from the default insurance provider, and they cannot proceed with their approval until they have that back. So they will reach out to one of the three providers, they'll get that insurance back. Once that insurance is back, they'll send their offer out stating what they're willing to offer for their approval.
I see. And would someone ever be denied getting this insurance?
Yep. Yep. People do get denied all the time. I would say a lot of the times, if the lender's not going to do it, the insurer probably won't do it either, or vice versa. So I would say, scenarios like this, like they do have some rigid policies. So some rigid policies are credit score has to be at least 600, no exceptions. Debt ratios have to be 39% GDS, 44% TDS. So the debt ratios need to be within a window as well. So yeah, for example, if someone had a 580 credit score, very good reason as to why, and we sent it in, even if the lender was like, yeah, you know what, we can get behind this story, the insurer is going to say no because they have a hard 600 minimum credit score. So yeah, if they're not willing to do the insurance, and we've seen that from time to time, lender is willing to proceed, the insurer is not willing to proceed. They'll try, and we've sent it to all three insurers. There are no other options at that point. It doesn't matter what lender we go to, the insurer is going to say no. So the only option in that would be to fix the problem or to put 20% down.
So could you summarize for me, what are those three reasons that someone would be denied CMHC home insurance or mortgage insurance?
Yeah, the biggest ones would be the credit. If the credit is too low, or there's a credit defect such as consumer proposal or bankruptcy, just kind of depends if the reestablished history isn't there or the minimum time isn't met. So like if there was a bankruptcy and it's only 1 year after discharge, they're probably going to say no. A lot of the times it's 2 years after. So credit's a big piece. The income and the debt ratios, that's another big piece as well. It has to be within those guidelines. And down payment, a lot of the time, down payment is more on the lender to verify. But, there could be a scenario where it's borrowed down payment from like the down payment assistance program and the credit score is really low, like 610. And that's when the default insurer is like, no, we can't get behind a borrowed down payment and a low credit score.
Okay. And from your perspective, Alex, as a certified mortgage broker, like, is CMHC mortgage insurance, like, is it worth paying for, or should someone who wants to buy a home in Nova Scotia wait until you have the full 20% down payment saved up?
Yeah, it's a great question, and it's kind of a loaded question too because it depends. So it really depends on what the difference in the rates are between the insured rate versus the non-insured rate. Typically, that difference needs to be quite large. We've run that scenario before for clients that have 20% down, but they're saying, "Hey, what if I just put 19% down and pay the insurance?" A lot of the times, it doesn't make sense for the lower rate. It's better to get to 20%. Um, and I would say, if you're at a 5% down payment today and it's going to take you a couple years to save 20, uh, I would say just go with the 5% because that's going to allow you to get into home ownership today. Whereas waiting, you're paying all that additional money in rent potentially, and maybe you're living at home and you can save. But if you're interested in buying a home now, I wouldn't let that hold you up by having to pay that insurance because, just waiting, who knows, maybe houses are going to be more expensive, maybe they're less expensive. Maybe you've got a whole bunch months or years of rent that you have to pay as well. So yeah.
And when you have CMHC mortgage insurance, obviously our mortgages renew every 3 years, every 5 years, depending on what mortgage you get. So is it possible, Alex, to actually like remove your mortgage insurance when you renew a mortgage?
Maybe, yes. If you do a refinance, so if at renewal you decide to take some equity out of the property or make any other changes, like maybe change the amortization, that could break the insurance that you have so that the insurance is no longer in place. A lot of the times people wouldn't actively seek out to just break the insurance because that's going to give you a lower interest rate if it's insured when you're renewing into your next term. So a lot of the times that's going to allow you to get insured rates, which typically will be lower than the other rates available in the market.
Okay. And if you need help with getting CMHC mortgage insurance or just figuring out how to get a mortgage with less than 20% down, or even if you have 20% down, reach out to Alex. He's here to help and is very helpful. I'll include a link down below this video. And of course, if you have any questions for Alex, please let us know in the comments on this video, and we'll be sure to cover it in another video, which is why you should subscribe to Alex Lavender on YouTube, and we'll see you in the next video.